Welcome, everyone. We're going to wait just a minute, let more people hop on, but I hope you're having a great start to your Wednesday. As for us, it has been cold and rainy here in Orlando all week long, and I do realize that not a single one of you feels sorry for us, but it's all right. We'll be sunny soon enough. We do want to start doing these webinars once a month for those that are on right now. We did a series of them when COVID broke out a couple of years ago, and we just felt like people needed to know what was going on and needed some updated information. So, once we realized that was going to be under control, then we stopped doing them for a while. But we're back. We're going to do these once a month moving forward. Just feel like there's a lot of information we can get out to our clients. So we'll wait just another minute or so. All right, let's go ahead and jump into this. We are recording it as well, so a recorded copy will be sent out to everyone either later today or first thing tomorrow, so you will have a copy of it. But I'd like to start off by introducing myself. I am Jason, the Business Development Manager here at the Realty Medics, and joining me is one of our owners, Ben Sensenbaugh, and we are here today to talk about our new Upfront Rent program. So, Ben, if you don't mind just asking you a few questions.
Absolutely, Jay. So we do every day. I'm excited to be here.
All right.
Back into your Zoom account to get me added as a panelist. So.
Oh, did you? Okay. All right. And if anybody has any questions along the way, feel free to drop them in the chat, and we'll make sure we get to them. We address them. We may not address it right away if we know it's something that's coming up that we're going to discuss, but feel free to ask away, and hope you get some good information out of this. So, Ben, could you define for us what Upfront Rent is?
So Jay, as you know, we're super excited about this new program that we have put together, and what we're calling it is Upfront Rent, which is guaranteed rent for the entire year. We have partnered with a company with a $500 million balance sheet that's able to they underwrote us as a company because of our screening criteria and the way we run our business, all the processes and procedures. So what we did is we partnered with them in order to give our owners all 12 months of rent up front on the first week of the lease. So it's a program where it doesn't matter if the tenant doesn't pay, if they have to get evicted, if they leave early, all those things doesn't matter. That company is going to take the risk, and along with us, and we're going to place a new tenant in there for you for free, but we're going to give you the rent up front.
Okay. When does this product officially launch? Is it good to go now, or is there a time period that we have to wait?
We're doing a couple more beta tests just to make sure that internally, but if anyone's interested in and has a house vacant now, they can actually participate now. This will be automatically offered to every single new lease starting in about 2 weeks or so. So it'll just be an automatic email and say, hey, would you like to receive this amount of money? You can click on it to learn more. You can discuss it with one of our partners, and we can move forward.
Okay, so this is a totally optional program, but if I decide to participate, the next step would be getting that email saying, here's what we can do for you and what we can pay out.
Yeah, we can answer any questions you have about the program. A lot of people who I've explained this to says, hey, what's the catch? Honestly, there isn't a catch. There's three rules that we have to stick with. Is you can't sell the house during the 12-month period. You have to use us as a property manager throughout that 12 months. And third is you have to do all of what we consider required rent in the house, in the property. Other than that, There is a fee, a percentage fee for providing that upfront, and that's a sliding scale. It will never be more than 10%. And there's a couple factors that we're still ironing out on how low it will be, but it could be as low as 6% if you have multiple properties or something like that. And we're also going to look into other offerings later on in the year of a shorter time frame. Another thing good to mention is, this is not a loan. This is nothing that's going to hit your balance sheet or any of that. It is actually just giving you the rent up front, and then we're just going to collect the whatever rent is collected. We'll just pay that to our partner.
Okay. Now, is there anything to restrict me from being able to participate, or the minimum qualifications, or what's the criteria there?
Nope. You have to be a Realty Medics client, and that is the only thing that's the only restriction that we have. I did see a quick chat message about, the sliding scale is not figured out yet completely. Right now it's at 10%. We're trying to see what else we can do about lowering that a little bit. But right now it's sticking at it's at 10%. But if it does get lower, we'll definitely let you know. But that's kind of what to plan on for right now, and then maybe get surprised later.
Okay. Somebody had asked, what is required rent? You had said there was a third condition to that. Do you remember what you said?
Required repairs.
Required repairs. Okay.
Yeah.
So it looks like we got a couple of different questions on that. Could you just quickly repeat the three conditions?
Sure. It's so you can't sell the home during the upfront period. So those 12 months, you cannot sell the home, and you can't refinance the home. Second is you cannot cancel with us for any reason. And third is you have to do the required repairs on the house. And that's something that we would, look at. We're not going to make you, repaint the house or anything like that, but we got to make sure the condition of the home is still rentable, and that will not cause the tenant to any undue stress and things like that. So okay. We'll be fairly clear about those things, but ultimately it will be the Realty Medics decision on what is required and what's not required. Mm-hmm. The owner is still responsible for all of the repairs on the house. So you will have to contribute in. If there is, let's say the air conditioning stops working, there's a $300, evaporator clean fee or something like that. You would have to contribute those funds at that time.
Okay. We do have another question here. Does the eviction protection fee go away?
Nope. So the actual legal expenses, if in the super rare event that the tenant actually has to be evicted, and the legal fees are filed, then the eviction legal part of the eviction is on the owner. The replacement of that tenant is free of charge, and all of the rent that's expected throughout that time period through the eviction is still not owed back. That is not part of the risk, but the actual legal fees would be part of that. If they have the eviction protection program that we offer for $15 a month, that would cover everything. And we would take that $15 out of the upfront payment in the very beginning if they wanted to continue with that.
Okay. Somebody asked, is the rent you pay the landlord upfront the same as what you collect from the tenant total throughout the year? I think we kind of addressed that.
Yeah, whatever the lease amount is we'll multiply that times 10. So if it's $2,000 a month, then the annual amount will be $24,000 minus the fee, minus the management fee, minus the tenant placement fee. And as long as you don't have any other reoccurring charges, like maybe a pool vendor or an HOA payment that you want to include in your management fees, then you'll get the remaining amount. So you don't have to include the pool, lawn, or any other fees that are reoccurring. But if you don't, you got to make a contribution for it. If you don't have any of those fees, then only thing you would ever have to do a contribution for is if you had some maintenance that need to be done throughout the year.
Okay. Another question here, is the 10% fee replacing the 8% management fee?
It's an additional. It's to give you all of that cash up front. So we are still collecting and managing the home. So we're going to take our management fee out of the lump for the sum, but we're going to have to allocate that throughout the year because we have to obviously manage the property exactly the same standards as we do now.
Yeah. And just to clarify, if there's a certain month goes by and my tenant can't pay rent, or they get evicted or vacate the property, That's on you, right? That's not on me anymore because I've got my money.
That's correct. Yeah.
Okay.
That has nothing to do. It only in, like the one of the 7 or 8 evictions we did out of all 1,500 leases last year. You're one of those 7, unfortunately. Then that's the only time you'd have to pay the legal fees.
Okay. Now, what are some options? I mean, obviously, it's entirely up to me, but if I decide that I want to do this, what's the benefit of getting that money up front? Is there go invest it elsewhere? If I have a better investment, I don't have to spend months and months saving those funds.
Yeah, I mean, everybody's going to have their own situation. For me, I participated in this already. I was the first one with some of my rental homes. I did too. And I brought that money in and I actually put it down on a down payment on another house. So, but you can, if you got a roof that has to be replaced in the next year, you want to pay off your car, whatever you think is at a higher rate, or however you think you can invest your money to make it work better for you.
Sure.
Cash is king now. You're going to get the same amount of money today almost. Can you beat that? Whatever that, that interest is. Yeah. Worth it. High value of money.
Yeah. If you had some high interest credit cards or something along those lines, but just coming to me now, but we're going through this period of inflation. The cost of money today is going to be greater than the cost of money next year. So
absolutely. And you combine that with the possible the tenant missing a month, or you have a vacancy period of anything, you eliminate all the risks and guarantee your cash up front. Mm-hmm. It really looks, it can be very attractive.
Yeah. Sure. Yeah. So it makes a lot of sense if you have a property you own free and clear, you get all that money less your initial expense up front. Now, let's say I have a mortgage on my investment property, but I am cash flowing. And as a real example, I'm cash flowing about $450 a month on my personal investment property. Obviously, I'm going to allocate a year's worth of mortgage payments. I'm not going to spend that money, but I got the $450 times 12 months. That's $5,400 less this initial expense. I'm still getting a chunk of change that I can, go invest elsewhere or pay off a credit card or pay off my truck, whatever I want.
Exactly. Or reinvest in real estate too, of course. Yeah,
okay.
There's a lot of options for there. Everyone's going to be slightly different on what they want to pay off or what charges they have coming up versus reinvesting into the market.
Okay. Maintenance issue comes up. How would we handle that specifically?
Well, first we'll determine if we feel it's required. If the AC goes out, of course, we're going to have to send out a technician. But if it's something that is, a fence falling down and it's not required by the HOA or something, maybe we can push that off. Just let you know if you want to pay for this now. But if it's a water leak, if it's anything that's going to cause the tenant undue stress or uncomfortable that are required by law or to keep the standard of our properties, then you have to make a contribution and you're gonna have to pay for that.
Okay. Do have another question here. Is this program available to existing leases?
So it will be available to existing leases. That'll probably be towards the end of February when we get all the technology rolled out for that part of it, but absolutely it will be. We're also hoping it'll be for shorter periods of time as well. Probably about a month away from renewals. There is one other condition to that. To be eligible for a renewed upfront rent, you cannot have an NSF fee by the tenant, and a rent payment cannot be later than 5 days. Those are the only 2 requirements. We want to make sure we have a good paying tenant in there already, which for the most part we always do. But there is an additional qualification for renewal.
Okay. Now, do you have another question here? I think something might have been miscommunicated or wasn't properly communicated. It says, initially you said you would place a tenant for free. Later you mentioned a leasing fee. Please clarify.
So the leasing fee is for the first time we place the tenant. That will be taken out of the upfront rent annual payout. If the tenant leaves for any reason, breaks a lease, leaves town without saying anything, or is evicted, or whatever it is the case for not completing that lease, we will replace that tenant for free. There will not be another leasing fee, as well as you won't miss any payments because you've been paid all of that rent up front.
Yeah.
So,
okay.
All the management fees stay in place.
Okay. Question here, what if a lease ends and we're going to increase the rent? How would that be calculated if you pay it all up front?
Well, the 12-month payout is for the lease term of, so if it's 2,000, the whole lease right now is going to be paid up front, 24,000 minus the fees. So at the end of that period, if we want to raise the rent, 5%, then you're still qualified to get the next year's rent up front, you can do so for an increased amount. So the upfront rent is always just for the current lease that's in place for the current amount.
Okay.
That makes sense.
Looks like we need a clarification here. So available to existing leases only upon lease renewal.
Again, that will be, we're hoping to offer things in the future, but right now that is what we're looking at. But I don't expect that to be very far into the future. We just want to make sure we're covering all our bases, and from a system standpoint, we get everything just right. That is definitely possible. I think it will happen. It does not have to be just on lease renewal, as long as, again, that you don't have a non-sufficient fund charges or any late payments past 5 days. But we hope to offer that product as well. Okay.
Another question here. How are rent increases handled in this market with rents rising rapidly?
Well, at lease renewal, we're looking at that, and we're giving the owner the option of what it would currently rent on the market, and then currently keeping a good paying tenant. So, usually there is going to be a gap between there. We usually look at $200 to $300. If we're farther than that out from what it could rent for on the open market versus what it can be renewed at, then it might be worth asking this tenant to leave and then replace the tenant. But we're trying to increase the rent all the way up to $100 in some cases, sometimes a little bit more than that if we really want to kind of push it. But we are watching a big jump in rental prices. That $200 to $300 is because you're most likely going to experience a 30-day lapse in rental payments while it's vacant to get repaired and get back on the market. And then also there's again another leasing fee. So with those with a lapse of $2,000 for that vacant month plus maybe a $1,500 leasing fee, that equals about that $300 that you would lose for the next year. So it's up to the owner.
All right, so $24,000 less the leasing fee and the management fee is paid up front. Then the owner deals with repairs only.
Yeah, if we're going to calculate it exactly, it's going to be the fee for the loan, or not for the upfront rent. It's not a loan at all. I shouldn't have said that word. The upfront rent fee, and then the management fee for all 12 months, and then the leasing fee. Then you'll receive the remaining balance of that. It'll be all very documented, very clear when you talk to the agent or our customer service representative. It's going to be super clear on what amount of money it is. But that is basically the fee for the service, then the typical management agreement that we have in place. So your monthly management fee for 12 months and the one-time tenant placement fee. Okay.
And this is something I can do every year. It's not a one-time option. I could repeat it next year if I want.
Correct.
Okay.
There is no limits to this program. Again, we're the first company in the nation to offer something like this. So we're going to, and the company has already been vetted who's going to help fund all of this. They have $500 million on their balance sheet. It's a major insurance player in the industry. So we hope this expands significantly as long as everyone wants it. It makes sense to them.
Okay. Now, I know you said one of the conditions was we can't sell the house. What if something comes up, I'm involved in this program and there's just absolutely no way around it. I've got to get out of it, or I have to terminate somehow. Obviously not through any fault of the realty medics, just life happens. Yeah. Is there a way to reconcile that?
The agreement is pretty straightforward. I mean, as long as everything's paid back, I would assume, but again, I'm not a lawyer. I didn't write the contract. So if you pay all of the upfront money back and you want to sell or something happens, I would assume that would be okay. I mean, as long as you pay your debt back, yeah. I'm sure, but If you don't, the contract is very favorable for us who provided the money to ensure that we put a lien or whatever we need to do to recapture those rental payments.
Okay. Another question here. Well, that works the same if the lease is renewed and it's not a new lease. Correct.
Yeah, it'll be just another period. You'll qualify for another upfront rent payment upon renewal. And once that renewal is signed and that first month of rent has been paid, then funds can be distributed again. It'll be a separate, exactly the same. Yes.
Okay. Another comment question here says, this program sounds really good, except for the 10% participation fee. You alluded to changing that in the future. Is that being discussed? I came in a bit late to the session. As feedback, I see paying no more than 5% for this.
That's the fee right now. That's the best I can negotiate. They're open to lower it. That fee doesn't go to us, just to be very clear. None of it does. So it's just the short-term lending side of things without calling it a loan. But I think as this program expands and more people are interested, I think this economies of scale that the price is going to go down. And some of those questions have been asked by me, but we're gonna have to roll it out and kind of feel it out. But right now it is 10%, but I think there's gonna be additional products shortly.
Okay. I think I missed the response on this one, but how do we handle services that are included with rent, the lawn service, pool service, HOA? That's something that could be paid out as part of that.
That will be part of a cost sheet. If the house does have additional reoccurring expenses that the owner wants us to pay, then we can take that out before the owner gets the remaining balance. So if it's $100 a month for lawn, we can take out that $1,200 and hold it into the reserve account, and then we'll pay it. So they would just receive $1,200 less of the upfront payment. And
if it's something that I'm handling separately with one of my own personal vendors, I can still get the cash and I can just take care of that on the side myself.
Yeah, of course. If you're handling your own vendors for any reason, you want to pay your own HOA, please take it. I'm joking. We love HOAs, but no. Yeah, if you want to pay your own lawn vendor, pool vendor, or whatever, if it's in the lease to be required, that's the only thing I want to make sure is if it's required and you pay it, we have to make sure it's always paid. So currently we don't have a single owner who's paying for lawn or pool that's required by the lease. So I'm not sure if we would change that. So allow the owners to do that, to be really clear, I guess. But if there is your own maintenance or things outside of that, of course you can use your own vendors to handle it and not make a contribution.
All right. Well, I do not see any other existing questions at the moment. Are you ready to move on to tax cost segregation studies?
Yeah, of course.
Okay. So what is this? What is a tax cost segregation study?
Well, not being a CPA, you got to talk to your own tax professional. But I think I've mentioned cost segregation studies to my friends and some other professionals in the industry, and it's kind of known in some areas, and it's really not known in a lot of other areas. And what a cost segregation study is the ability to do an engineering study for any kind of real estate. Commercial is where this is mainly focused, but if it's residential, to break down the components of mechanical and personal and depreciate those items faster than the actual building itself, the structure. So I know that was a lot there. So in layman's terms, right now, you depreciate at 27.5 years. If you bought a house for $200,000, what is it like? You're going to depreciate on your taxes about $7,200 every year for the 27.5 years. But if you place a house in service in the tax year you're filing your taxes, so let's say we're talking 2021, you placed the home in service, which means it's available to rent. Not that you purchased it, but it's available to rent date. Then you can have a engineering study done, a cost segregation study done on that property, which will allow you to depreciate things on a much faster depreciation schedule. For example, your water heaters, your air conditioning, your roof. Water heater might be 5 years, your carpet might be 5 years, a roof will be 15 years. You're able to accelerate all those depreciation items into those faster time slots, because carpet's not going to last 27 and a half years. Your roof probably is not going to last that long. So these engineered tax studies are able to break down all the components within a property and define them into certain boxes. The really good thing about this is that you can take all of those accelerated depreciation as what we call bonus depreciation. So you can take all of those write-offs in the year you place the home in service or the property in service. So that can be upwards of about 30% of the value that you bought the property for. So a $200,000 house, we're talking more than $50,000 of accelerated cash basis money. I'm just looking at a sheet here. Cost seg first year depreciation increase. You can go up to 50,000 or 30% of the value. It will depend on the exact study. So what that means at the end of the day is you're going to get a lot more taxes left, or you're going to have a lot more passive losses, which is really, really going to lower down what you actually owe in taxes. This can be used in, it only can be used unless you're a real estate professional. It's only be used in the last year. So only if you bought a house in 2021, a new house, or you put some level of improvements. All those improvements are also deductible. But you got to hire a firm I've done this for every single one of my properties. It was a huge tax savings. So I don't know. I think I defined and did a whole bunch there, but it's a great tax. I don't know which benefit that every rental owner should at least look into to see if they qualify for it. Okay. There is a cost for the cost segregation study too, of upwards of $1,500, $1,600. It just depends on the exact house, but the cash back that you can get is 5-10 times more than that, actual cash, not a deduction, depending on your tax situation, of course.
So is it beneficial for a single property or more so for just a portfolio?
Well, it can be you'll have to ask for what they can do for you. If you bought multiple properties in 2021, they'd all be eligible. You can do it on one. You got to and you can see if it makes sense. I'm told it does. It did for me. I did multiple in the same year, but now I have passive losses for future years though. So it was super beneficial in my case. They'll provide a free analysis on what the expected returns should be, where you were sitting, and does this make sense? I haven't had anyone say it doesn't make sense to pay the $1,500 to get the money back. There is you also have to do a one-time, it's a IRS form 3115. It's the change of accounting standards. That one also costs, once you do that one time. So if you've been, I'm kind of going into the weeds here, but if you've been depreciating something in previous years and you're a real estate professional, you can change your accounting standards because you've been reporting it for 27 and a half years. You can now change it to take that accelerated depreciation. So there is a form for that, but I would definitely look into it. I use Engineering Tax Services. They were super great to me, and I've referred a lot of other people to them. So.
Well, I was just about to say we hadn't gotten any questions, so I think everybody was either thoroughly confused or tuned out, but we did get some populate here. So do you have a company or companies you recommend for cost segregation?
Yeah, it's called engineeringtaxservices.com. If there's enough interest in this, we can have one of the representatives there maybe join us on the next webinar. That's who I talked to, and I'm pretty good in the accounting world, but she completely, glazed my eyes over. I was like, what did you just say? So, but I think she can talk normal as well, but she's a really good CPA. So to be clear though, what that statement is, this company will do the engineering tax study for you, but you're going to continue using the same CPA you always have used. They're not going to file your taxes for you, they're going to give your CPA everything they need to continue filing your taxes. My CPA was even on the call as we did this to make sure we got all the relevant information of previous reporting and stuff like that. And then they just pretty much handed us a sheet that we filed with the current year taxes.
Okay. Another question here. How do you get qualified for that and to enjoy the 2021 tax deduction? Did I need to do the analysis last year? Or can I still do it this year and apply for last year?
You can still do it this year since you haven't filed this year's taxes yet. So yeah, 2021, you still got plenty of time before you file your April 15th. You can delay it past that, but in some cases, you can even do the cost segregation analysis after you file your taxes. That's the question that they're going to really have to answer. Again, if anyone qualifies as a real estate professional, there are some additional benefits, but I won't go into that because yes, we are not all in the real estate world.
I do have an off-topic question here, but it's a good question, so I'm going to ask you. Do you know why home insurance premiums in Palm Bay have doubled in the last 2 years compared to a minimal increase in Ocala? What is unique about Palm Bay in the last couple of years?
I don't have that answer exactly, except for just a lot of expansion on the growth side. I have houses in Palm Bay and I have houses in Ocala, and I'm only seeing about $250 difference for a 1,500 square foot house. So I guess I'm not fully seeing that, but if I'm looking from an insurance standpoint, Palm Bay is only 20 miles from the ocean and Ocala is 150 miles or 100 miles. So there is definitely some wind and other considerations to think about in Palm Bay. They require impact rated windows or shutters, where Ocala, you don't have to have anything related to wind. So I would maybe shop that around. I have a good guy that if you ever want to know for insurance quotes and stuff like that, is the guy I use personally. Happy to share any of that info.
All right. Another question here. Did you say that landlords who are not real estate professionals cannot have a cost segregation study performed on a house that we have owned for several years?
The real estate professional part of it is not required to do a cost segregation for last year. The thing you need to talk, if you are a real estate professional and you placed a home in service in prior years, not 2021, you need to talk to your accounting professional. Most likely, you're not going to be able to go back in time and do a cost segregation study on a house you placed in service in 2018. The cost seg needs to be done in the year that you're going to be filing your taxes or before you file that year's taxes. If you are a real estate professional, you do have a benefit, at least it was last year, that you could roll back and do prior years. So in case you are, that's a question to ask, but most likely you cannot go back and do a 2021 cost segregation for a property put in service then.
Okay. If you get a lot of passive losses by cost segregation, then what good is it if you can't write off and just accumulate it? Also, will there be a future problem in getting a new loan if there's too much passive losses on the tax returns?
Read the first part again. I know it.
We'll make it a two-parter. If you get a lot of passive losses by cost segregation, then what good is it if you can't write off and just accumulate it?
Well, your passive losses can stay on the books. So if you've used all your passive losses, then your tax bill is going to be significantly less. You're not going to owe very much money. And then once you've finished your tax, then you can use it for future years as well, as long as it's a passive loss. So I'm not going to go into the exact percents and stuff because that always changes, but your passive losses can be held. Once you use them all up for this year, they can be left on the books to use in future years. What's the next question?
The second part of that is, will there be a future problem in getting a new loan if there's too much passive losses on the tax returns?
Passive losses will not impact getting a mortgage in any way. They will look at your income. They don't look at what your final tax amount is. So as long as you're still making income, you're still qualifying, your debt ratio is intact, passive losses, cost seg will not have a thing to do with it. You know, most super rich, you know, file losses every year, and they still get plenty of loans. So that will happen for the normal people like us as well.
Okay.
Taking a loss. So
next question here. I think you've pretty much addressed everything.
okay.
It's a one-time study, right?
Yeah, it's a one-time. It lasts lifetime of the loan. Usually, some of the other questions I get on it is, what happens if you sell? And you know, cost seg, if you're flipping a house, or if you're planning on only owning a house for a couple of years, might not make sense. But if you plan on 5 years or longer, it definitely makes sense. There's something called recapture. The recapture rates on you know, owing depreciation back, no matter if you did a cost seg or not, you're always going to owe some level of depreciation back as long as you didn't make it all the way to 27.5 years. You're going to owe some of that back. But as long as you hold it past 5 years, you're going to make more money in the cost segregation benefits than what the recapture fees will be. So it does always make sense. You don't have to pay it all back or any of that kind of questions I've had. So yeah, I think that's, I'm trying to think. I wrote down a couple things here too, just make sure. Yeah, I think that covers it. It's just also a way so you have a lower tax bill than when, again, to use that money for it. Same with upfront rent. You should have additional funds ready to use this for something else. You don't have to, but it's always a good idea to reinvest all that money you just saved, so you can do another cost segregation next year, another one the following year. It's a great tax strategy to have.
Okay. Another one for you here. Is this study relevant in all states? And can you send an email with details to all the owners?
Yeah, it's relevant in all 50 states. It's an IRS publication. They make it a little challenging. Then, you know, straight line depreciations for everybody. They kind of don't want you to do this other way, but they just make it a little bit more challenging. It's why you have to have a certified engineer do this study. But honestly, I would just have you go to taxengineeringservices.com. Let me make sure 100% engineering. engineeredtaxservices.com. So just go to engineeredtaxservices.com, and they're going to be the professionals. Again, we can send out a link to their website. I mean, I haven't talked to them, but we can talk to them and even bring in more information and have them talk here as well.
Well, that's it for the questions I have, and it looks like nothing else is coming in. Do you want to give them a hint on the topic for next month's webinar? Or have you decided?
I think you're the host. You know, I think we have a lot of exciting things coming out. So, you know, there's one will be on what we call refi until you die. I think that's another way of looking at your money for next time. We can continue talking about cost segregation and maybe have them talk to us for 10 or 15 minutes. And then we have another product rolling out. It's called the Property Performance Dashboard, which is using all of the data that we have collected over since we've been in business for cash flow, for expenses, and also being able to see kind of transparent on how your property is being managed in a live, from a live performance standpoint, as well as pulling all of the data on current values and equity and calculations. So it's a whole mouthful, but if we kind of show it, it's called the Property Performance Dashboard. It's what we think all investors should have to be able to make smart decisions on their properties.
All right. Well, it's been a little challenging trying to ask these questions and monitor these that come in. So if we missed anything, please send me an email directly, jason@therealtymatrix.com, and we'll get you the answers you need. Otherwise, we'll send out an email with the next webinar, and we'll go from there. Thanks for joining us.
Awesome. Thanks, everyone.
Bye, everyone.
Bye.